I just want to just quickly go over my background. I am a Long Island native, and I actually went to school very close to here at RPI, which is in Troy. So it's just nice to come up to the area again. The company that I talked about was Radiant Systems. If you ever go into Hess stations, Dunkin' Donuts, a lot of restaurants, you may see a touchscreen-based convenience store, restaurant management system, and move into many vertical industries, movie theaters and whatnot. That was a company I started back in 1985 with a couple other graduates of Syosset High School. The company went public in 1997, and just on August it was bought out by NCR Corporation. So NCR wanted a presence in that retail industry, and it's much easier to buy something than build it. And the buyout price was a hefty $1.2 billion, so that wasn't bad. It's something I'm proud of, but it feels like a whole life ago. I'm in my 10th year teaching at Syosset, and these are the courses, as the nice lady discussed. Also, something else I do is I know that one of the 7 habits is this sharpen the saw thing. I always like to learn, always like to be creative, and a couple of years ago I took the Series 7 license and the insurance licenses and whatnot, and surprisingly I did very well without having to do all that much studying, because in the courses I teach, obviously to teach you need to know it and know it intimately, and so when it came to options and bonds and all the rest of it, I was able to just motor right through all that stuff. I created Investings.com really to satisfy an itch. For years, when I was teaching the investment class, I would send kids to 2 sites, either Investopedia or to InvestorWords, to look up financial terms. So that was kind of where this thing started. They'd write the definition for me. I'd ask a student to read it back aloud. The kid would read it back aloud. Then I would ask the fateful question, what does it mean? He says, I have no idea. So I thought, this is not really being very effective. So I thought I could do better, and I basically set out I started conceiving this, let me take a shot at creating my own glossary. So just to show you, this is what kind of you run into with InvestorWords. I mean, technically it's correct, absolutely. It's a debt instrument. I think instruments are things kids play, but it is a debt instrument issued for a period of more than a year. I'm not even sure that that's accurate, again, because it's not being issued like over a course of a year. Its duration or term might be more than a year. And then, of course, that begs the question, well, what if I wanted to do it for 9 months? I mean, would that be legitimate? So I just run into trouble. Also, everything that you see highlighted in the InvestorWords definition is a link to yet another term. So that also kind of makes the thing further involved. Here is the Investings definition of a bond. It just says the piece of paper an investor receives when loaning a company or government money. Among the information printed on the paper is the amount of the loan, the annual interest the borrower has to pay, which is usually broken into 2 payments, and it's expressed as a percentage. And this is the investor's rate of return. People go, well, how do I know if it's a good? There it is. The interest rate is your rate of return. And then the last thing is the date on which the company or the government must pay back the loan. I understand it's a little longer, but I feel like it's what you need to know. And the fact that I described it as a piece of paper, I can get away with more things, being that this is educationally oriented. It doesn't need to be technically perfect or correct. Somebody said, well, you don't really get a paper in real life. Well, guess what? My assertion that you get a piece of paper lets the student know that there's an exchange going on. Give money to the corporation, the government, you have something in your hand that basically evidences the fact that you gave that corporation or government money. The InvestorWords definition of a mutual fund is an open-ended fund. So the word fund is in the definition as well. Open-ended, not sure what that's about, not sure what an investment company is. So again, it's just got a lot of stuff in it. This is InvestorWords. That's their way of defining mutual fund. This is Investopedia's way of defining mutual fund. An investment vehicle, again, that's something I thought I used to drive, but a pool of funds collected from many investors. Again, it's in there, it's the right thing, but one of the things that I found in creating my definition, which is very different, it's a whole different take on it. It's a corporation that does not produce goods or services of its own, but instead carefully invests its shareholders' money in the stocks and or bonds of corporations that do. Because the idea is that a mutual fund is like, well, they actually piggyback on the success of other entities. And if they carefully do that, invest in the right companies at the right times, they can make a profit. But they themselves don't offer anything other than the ability, hopefully, to invest wisely. And so by creating a definition like this, they immediately realize, oh, this is what's happening here. It's just a different approach. But this is probably the thing where I vary the most from a traditional definition, because I just thought it conveyed what needed to be said. So here we find the first objective of the site is education. I just wanted to build a better glossary. So the other thing about creating the glossary was I felt every single term in the glossary has an example, every one. Because you know how you can still have a question after you read the definition, then you read the application of it, and then you say, okay, what I thought I understood is actually indeed correct. So every single one has an example. Every single definition also has an Invest Teens Explains section, which is basically everything you need to know. And it also, having taught so many years, I try to anticipate questions readers might have. So the last piece of it is what I call the riddle me this. This is something I took on a bachelor from Batman. It's just a series of questions that are checked for understanding. So as an educator, you can assign a student, go to investeens.com, go see dollar cost averaging, read the definition, answer the questions. I'll give you 10 minutes, and then we'll discuss. Okay, so I'm trying to do all the work for you in terms of preparing the important questions that will demonstrate whether the student has learned it or not. Okay. All right, so here's where you have dollar cost averaging. As you see, these are your major sections: definition, example, Investeens Explains, riddle me this. And I'm still building it. That's something else I was going to tell you about the glossary. So, for example, I've defined investing risks in other places, but as I add, these are the things I intend to define, and I don't have them yet. So when I do, I'll come back and create the links. But basically, I've said a dollar cost averaging. Just I don't know if you can read that, but I'll read it quickly. It's an investing approach where instead of investing all of your money at one time, you invest a portion of it every so often, such as once per month. The example is you save up a bunch of money working summer jobs and want to invest $2,500 of it on Nike. Instead of buying $2,500 of Nike stock today, you buy $500 of Nike stock on the first day of each month for the next 5 months. You eventually own $2,500 of Nike stock, but you will build your position over time. Okay, so that's your example. And Investeens Explains, here's what we say. Who says when you decide to make an investment in a company that you have to throw down all at once? By dollar cost averaging, you dramatically reduce market risk and timing risk. Curiously, as you follow this approach, you don't mind dips in the stock price. In fact, you may actually root for them. When the price is down, you get more shares when you make your next periodic investment. Finally, most adults practice this technique out of necessity. They don't have a pile of cash sitting around waiting to be invested. Instead, they work hard at their jobs and are able to use a portion of what they earn each month to add to their investments. Okay?